All right, everybody, what's up? It is Friday, October 18th. Oh, yeah. Remember, I am the only one who has an applied approach to MMT. I take the concepts and the understandings of MMT and I apply them to trading and investing in the markets. I'm going to start every video off with that statement. I think that's very important that I make that statement because I'm the only one who does this. There are a lot of MMT academics out there, and they're talking theory, and they're writing papers, but I'm the guy who has taken the concepts of MMT and developed an applied approach. Okay, most of you already know that, but I wanted to say it. All right, now, we're getting a little bit of a, by the way, a lot of things have happened. I didn't make a video in the last few days. I've been very busy. Dollar has started to come down. All right, we're getting news that there may be a Brexit deal. They're going to vote on it maybe tomorrow. So that's happening. But the rally in currencies is not only limited to the British pound, which of course would be affected by the Brexit deal. And by the way, if you go back, I don't know, several months ago when the pound hit, I don't know if we hit 119 to the dollar, a pound US dollar, but I said that is one of the grossest, most extreme mispricings of the Forex market that I have seen basically in all my trading career, which is like 40 years, all right? It's a long time. And where are we now? I mean, we're up almost at 130. We were down at, I don't know if it was 119 or 120, but it was way low. And I said that is a huge, huge mispricing. And you know, I've been saying this all along, that the hysteria over Brexit and what people believe would be the impact to the UK economy, you know, has been so exaggerated and distorted that it's just ridiculous. Anyway, so the dollar's coming down. Bond yields have backed up a little bit. Stocks very close again to an all-time record high. Now, if you go back a couple of weeks ago, you know, when we were having that correction, and then I said, okay, when the Fed came out with the announcement, it was what, like 2 or 3 Fridays back, that it was gonna, you know, start buying T-bills and everything like that. I had to re-look at that, and I made a video about it. I said, I gotta kind of analyze that further and understand it. And there was a sentence in there where the Fed said, hey, look, this is not QE. All we are trying to do is keep reserve balances at the level where they were in early September. And in early September, reserve balances were like 1.45 trillion, 1.48 trillion. Well, guess what? Since beginning with all that stuff, and since all that new stuff has been announced, you know, the repos and everything else, and the buying of T-bills, guess where reserve balances are as of October 16th? That's the latest data. That was 2 days ago on Wednesday. 1.485 trillion. Exactly where they said it was going to be. And the reason I bring this up is because when I explain to you, hey, I gotta figure out exactly what their intent is here, because I had been expecting a bigger correction in the stock market, it hit me that their efforts were not only positive, but B, necessary. And you could see this now, and I'll tell you what. So I flipped around, I said, you gotta buy every dip, and the market's going up. But look, here's the incredible thing. The Fed has added a total of 197.7 billion from these repos in reserves to the system. In the period of time from September 11th, when the amount of repos outstanding was 0, right? They had no repos, no liquidity injections, September 11th, and that's when they started to have all these problems with overnight rates spiking up, and then they said, oh, we got to do something. They started to pump in, and I got a little worried about that because I thought it was going to be open-ended, massive reserve dumping. So in that period from September 11th until now, They've added 197.7 billion of liquidity, okay? And reserves have only gone up by 11 billion. Do you understand what that means? There has been, if they didn't do that, we would have had a massive drain of reserves below the threshold that the system needs to operate, right? Because banks have to hold is a 10% reserve ratio. So you got 1.3 trillion in deposits. I'm sorry, you got 13 trillion in deposits. You need a minimum of 1.3 trillion in reserves for that 10% ratio. We would have been down to like 1.1 trillion, which means the whole system would have froze up. Overnight lending rates would have spiked way up. So in spite of nearly 200 billion of pumping, reserves only went up by 11 billion in that period. Pretty incredible. Pretty incredible. But the most important thing, and I'm sorry if I'm losing some of you in all this, and I know this is just like technical jargon. What does it mean? You're probably all thinking, well, what does it mean? I'll tell you what it means. It means what they're doing is providing stability. There's stability here now. They went way too, and it's funny because they weren't paying any attention to this stuff. They took reserve balances down too far, and they were kind of like on automatic pilot, and they weren't watching, and then you had this problem with the overnight rates spiking up. And now they're, they've rectified that. They've taken care of that. There's stability now. Anyway, it's bullish. When you look at the fiscal, which is record on top of last year's record, right? We started a new fiscal year. When you look at monetary policy now with just keeping, see, I was afraid they were going to pump and pump and pump and dump this huge amount of reserves. Anyway, let me move on from this. I want to talk about some mental game stuff right now. Folks, I mean, how many times have I been over this topic? I mean, it's so critically important. It is the most important thing to understand. The most important thing to understand. And in the last video, I talked about how what we do as traders, as investors, is very similar to high-level athletes, okay? And the winners, the ones who are successful, first of all, they never give up, they never quit, and second of all, they have the ability to overcome. And when you think about it as a trader or as an investor, the ability to overcome means when you are in a difficult situation, let's say a situation where the market is moving against you, your position is moving against you. Let's say you're in a situation, or it could simply be a situation where nothing is happening and it's kind of taken a lot of time, right? Conditions are not optimal. What's optimal conditions? For everybody, that means you put on a trade, it goes in your direction, boom, you make money. That's what 99.9% of you want and think that it's possible that you could just do something and you're making money every day and every week, boom, 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 no problem. You don't want to wait. I don't want to wait. Or when it gets tough, I'm taking prudent losses with my stop loss approach. Folks, let me tell you something. Losing is no good. Losing is bad. You cannot lose and profit. Whoever came up with this idea is ridiculous. If you are in a business, if you are running a business, and your business runs into some difficulty, let's say cash flow problems, any businessman that I know is going to go out and try to find funding to maintain their business because they believe in that business. They don't stop themselves out. They don't close down their business and go on to a new business. Only in this crazy world of trading is that taught as some kind of wisdom, as some kind of behavior that you should embrace. You cannot lose and win. You cannot, embracing losses. The only way in this game to profit is to be able to do two things simultaneously. Number one, Manage your positions. And if they're not working, and if you got it wrong, if you got the outlook wrong, let's say again, let's use the business analogy, you're running a business and you get involved in the wrong product, you manage your way out of it. You don't shut your business down. And you have to manage yourself. You have to manage your emotions. Most of you, your expectations, it's not that they're too high. It's good to have high expectations, but you're impatient. You're impatient. I had a guy saying, yeah, it's great if you got a lot of money, you could sit in. No, it's the same thing. It's all the same thing. It's all the same thing. Everyone starts with a little bit and has to build it up. Most everyone. If you're lucky and you come from some rich family or somebody gives you a ton of money, well, good for you. But most people start that way. And that's just a fact of life. It doesn't change anything. No, it doesn't apply to only people with a lot of money. It applies to everybody. Everybody. Anyway, folks, it's Friday. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one who has an applied approach to MMT. Have a great weekend. Bye-bye.